Welcome back to Ledger.Wealth.Network, where we break down what's really happening in crypto before the headlines catch up. If you want the signals, not the noise, you're in the right place. April 15th isn't just another day on the calendar. While you've been watching price movements and parsing through social media speculation, three massive financial powerhouses just synchronized their moves in a way that hasn't happened since the early days of the internet boom. The Federal Reserve pumped $8 billion into the system yesterday. Japan's largest financial conglomerate activated live blockchain payment infrastructure, and the world's most prestigious stock exchange quietly launched something that changes the entire game for digital assets. Here's what everyone believes. Crypto adoption happens slowly, institutions move cautiously, and regulatory clarity comes first. But smart money knows something different. They understand that when the New York Stock Exchange builds tokenization infrastructure, when central banks flood markets with liquidity, and when Asian financial giants prove blockchain payments work at scale, these aren't separate events. They're coordinated preparation for the largest wealth transfer in financial history. The proof is hiding in plain sight across 3 continents. And by the time I walk you through each piece, you'll see why April 15th marks the beginning of something unprecedented. Let me start with Japan, because what just happened there proves everything we've been saying about real-world utility. SBI Holdings didn't announce future plans or run another pilot program. They went live with actual blockchain payment infrastructure that processes real transactions right now as we speak. Their multi-merchant prepaid token system runs entirely on the XRP ledger, letting users load Japanese yen and spend it across participating merchants with 3 to 5 second settlement at near zero cost. Think about what this actually means. Japan's financial establishment just proved that blockchain payments can work invisibly at enterprise scale. Users don't even know they're using distributed ledger technology. They just experience instant, cheap, frictionless payments that make traditional banking look like sending letters by horseback. This isn't some cryptocurrency experiment tucked away in a corner. This is core financial infrastructure built on XRP rails, processing real money for real people making real purchases. But here's the part that connects everything. The same day SBI activated their payment platform, the Federal Reserve injected $8 billion in fresh liquidity into the American financial system. That's not coincidence. That's coordination. Central banks understand that when you're about to tokenize trillions of dollars in traditional assets, you need abundant liquidity to smooth the transition. They're essentially pre-funding the bridge between old finance and new finance. Now, let's talk about what the New York Stock Exchange actually built, because this changes everything about how we think about tokenization. They didn't create another crypto trading platform or digital asset marketplace. They launched a completely parallel financial system where traditional stocks exist as native blockchain tokens with instant settlement using stablecoins. Securitize leads the operation as the approved broker-dealer, but they're not just running trades. They're the design partner for how instant settlement works, how tokens and stablecoins move in and out of the system, and how this entire infrastructure scales to handle Wall Street volume. Picture this: every major stock, bond, real estate investment, and commodity getting tokenized and moving to blockchain rails with instant settlement. No more T+2 clearing periods, no more counterparty risk during settlement windows, no more massive infrastructure costs for clearing and settlement that get passed down to investors. Just immediate, final, irreversible transactions that happen in seconds instead of days. The question becomes, which blockchain can handle enterprise volume at enterprise speed with enterprise reliability? Bitcoin gets congested with high fees when too many people want to transact. Ethereum burns through expensive gas fees and slows down under heavy load. But there's one distributed ledger designed specifically for financial institutions that can process thousands of transactions per second with consistent sub-5 second finality at fractional penny costs. And that brings us to why April 15th matters so much. Rakuten, one of Asia's largest e-commerce and financial services companies with 120 million users globally, launches their massive XRP campaign next week. They're giving away up to 100,000 yen in rewards to drive adoption, backed by serious marketing budget and infrastructure investment. If just 1% of their user base touches XRP, that's 1.2 million new holders entering the ecosystem. But look at the bigger pattern here. The New York Stock Exchange builds tokenized settlement infrastructure. The Federal Reserve provides abundant liquidity. SBI proves XRP-based payments work at scale in the real world. Rakuten pushes mass adoption with financial incentives. These aren't isolated corporate decisions. This is synchronized preparation for something much larger. Every tokenized stock needs a neutral bridge between different blockchain networks and traditional finance. Every cross-border payment needs instant, cheap settlement that doesn't depend on corresponding banking relationships. Every digital marketplace needs finality measured in seconds, not days or weeks. XRP provides all three capabilities better than any other digital asset, which is why it keeps appearing at the center of institutional adoption stories across continents. Marcus Treacher, Senior Vice President at RippleX, explained it perfectly when he said XRP serves as the glue in the middle, the cream in the center of the Oreo cookie. As we move toward tokenized real-world assets and stablecoin-based settlement, XRP's role as the neutral bridge becomes absolutely vital. It connects different blockchain networks, different currencies, different financial systems, and different regulatory jurisdictions through one universal settlement layer. Here's what mainstream coverage won't tell you about institutional adoption patterns. When unconnected organizations across different countries start building complementary infrastructure that all points toward the same technological solution, that's not coincidence. That's confirmation that smart money identified the winning technology early and positioned accordingly. Wall Street institutions don't coordinate their moves through public announcements or social media campaigns. They coordinate through quiet infrastructure investments, regulatory positioning, and strategic partnerships that only become obvious in hindsight. The New York Stock Exchange tokenization system needs exactly what SBI just proved works in Japan: invisible, instant, cheap settlement that scales to enterprise volume. Rakuten's mass adoption campaign provides exactly what institutional infrastructure needs: real users conducting real transactions that prove real-world utility. This is why the technical chart doesn't matter right now. Price action reflects retail sentiment and algorithmic trading patterns, not institutional accumulation strategies. Smart money doesn't buy at market tops when everyone's paying attention. They accumulate during quiet periods when fundamental infrastructure gets built without mainstream recognition. They understand that utility drives long-term value, and utility is being built across 3 continents simultaneously. The Federal Reserve's $8 billion liquidity injection isn't about stimulating consumer spending or supporting traditional markets. It's about ensuring sufficient dollar availability when tokenized assets start moving through blockchain settlement systems at scale. Central banks learned from the 2008 financial crisis that liquidity problems can cascade quickly through interconnected systems. They're preventing bottlenecks before they happen. Think about the sequence here. First, prove the technology works with real transactions in a major economy. Japan provides that proof through SBI's live payment infrastructure. Second, build parallel settlement systems for traditional assets using blockchain technology. The New York Stock Exchange provides that infrastructure. Third, ensure abundant liquidity for the transition period. The Federal Reserve provides that capital. Fourth, drive mass adoption through financial incentives and marketing campaigns. Rakuten provides that acceleration. Each piece depends on the others, but together they create something unprecedented. A complete bridge between traditional finance and blockchain-based settlement that preserves everything institutions love about current systems while eliminating everything they hate. Same legal rights, same regulatory protections, same corporate actions, but with instant settlement, lower costs, and 24/7 availability. The institutional confirmation signal I watch for is exactly what we're seeing now. When multiple unconnected institutions across different regulatory jurisdictions start building complementary infrastructure around the same core technology, that's institutional consensus emerging in real time. They don't announce their strategies publicly because that would drive up acquisition costs and attract regulatory scrutiny before they're ready. But the infrastructure tells the story. Securities exchanges building tokenization platforms, central banks providing liquidity buffers, Asian financial giants proving payment utility, e-commerce platforms driving adoption, payment processors integrating blockchain rails. Each organization focuses on their piece of the puzzle, but the complete picture shows comprehensive preparation for blockchain-based financial infrastructure. Here's what happens next. As tokenized assets gain mainstream adoption, demand for bridge assets that can seamlessly connect different blockchain networks, different currencies, and different regulatory systems becomes absolutely critical. Bitcoin works as a store of value, but lacks the speed and cost structure for high-frequency settlement. Ethereum works for smart contracts, but gets expensive and slow under heavy transaction loads. XRP was designed specifically for institutional settlement use cases. 4-second average transaction times, fractional penny costs that don't increase with network congestion, built-in currency exchange capabilities, energy efficiency that meets environmental standards, regulatory clarity in major jurisdictions. These aren't accidental features. They're intentional design choices for bridging traditional finance and blockchain technology. The wealth transfer opportunity comes from recognizing institutional adoption patterns before they become obvious to mainstream markets. Right now, while retail focuses on price charts and social media narratives, institutions are quietly building the infrastructure that determines which technologies succeed long term. The New York Stock Exchange didn't choose XRP infrastructure randomly. SBI didn't build payment systems on XRP rails accidentally. Rakuten didn't launch adoption campaigns without strategic reasoning. Smart money understands that utility drives adoption, adoption drives demand, and demand drives sustainable value appreciation. They're positioning before the infrastructure goes fully operational and mainstream markets recognize what's happening. April 15th represents the acceleration phase where multiple adoption drivers activate simultaneously across different markets. By the time traditional financial media starts covering institutional blockchain adoption as a major trend, the positioning opportunity will be over. Smart money will have already accumulated during the quiet infrastructure building phase. The technical price signal that matters isn't chart patterns or technical indicators. It's institutional confirmation through coordinated infrastructure investment across multiple organizations and jurisdictions. The pieces are in place. The money is moving. The infrastructure is operational. And XRP sits at the center of institutional adoption strategies across 3 continents. While everyone else focuses on price movements and social media speculation, smart money focuses on utility, infrastructure, and long-term positioning. This is exactly what early internet investors saw in the late 1990s. Infrastructure companies building complementary systems that all depended on the same core protocols. Most people focused on individual company stock prices. Smart money recognized that TCP, IP, HTTP, and other foundational protocols would capture enormous value as internet adoption accelerated. We're seeing the same pattern with blockchain infrastructure today. Multiple institutions building complementary systems that all depend on efficient, scalable, cost-effective settlement layers. Most people focus on individual cryptocurrency prices. Smart money recognizes which technologies will capture enormous value as blockchain adoption accelerates. The question isn't whether blockchain-based settlement will replace traditional clearing and settlement systems. The question is which technologies will power that transition. Based on institutional adoption patterns across the New York Stock Exchange, SBI Holdings, Rakuten, and dozens of other major organizations, the answer is becoming clear. Don't let short-term price volatility distract you from long-term infrastructure trends. The institutional adoption wave isn't coming. It's here, building quietly while mainstream markets focus elsewhere. April 15th marks the acceleration phase where multiple adoption drivers activate simultaneously. Smart money is positioning now before the infrastructure advantages become obvious to everyone else.